Hey there, everyone! Welcome back to our channel. I hope you're all having an amazing day. Today, we're diving into a topic that affects all of us who invest: taxes on investments. Whether you're a seasoned investor or just starting out, understanding how to reduce the taxes you pay on your investments can really help you keep more of your hard-earned money. So, let's get right into it. Now, here's a question for you. Have you ever wondered how some investors seem to pay less in taxes while growing their wealth? What's their secret? Well, today we're going to explore various strategies that can help you minimize your tax burden on investments. Let's get started. First up, let's talk about tax-advantaged accounts. These are accounts that provide certain tax benefits, allowing you to invest your money more efficiently. The most common types include individual retirement accounts, or IRAs, and 401 plans. For instance, if you invest in a traditional IRA, your contributions may be tax-deductible, meaning you can reduce your taxable income for the year. This allows your investments to grow tax-deferred until you withdraw them in retirement. On the other hand, with a Roth IRA, you pay taxes on your contributions up front, but your withdrawals are tax-free in retirement. This can be a powerful tool if you expect to be in a higher tax bracket when you retire. Next, let's discuss capital gains. When you sell an investment for more than you paid for it, you incur a capital gain, which is taxable. However, not all capital gains are treated equally. Short-term capital gains, which apply to assets held for 1 year or less, are taxed at your ordinary income tax rate. But long-term capital gains, for assets held longer than a year, enjoy lower tax rates, typically 0%, 15%, or 20%, depending on your income level. So, if you can, try to hold on to your investments for longer than a year to take advantage of these lower tax rates. For example, if you bought stock in a company for $1,000 and sold it for $1,500 a year later, that $500 gain would be taxed at the long-term capital gains rate rather than your regular income rate. Another strategy to consider is tax loss harvesting. This is a technique where you sell investments that have lost value to offset the taxes you owe on gains from other investments. Let's say you have a stock that you bought for $1,000, but now it's worth $700. If you sell it, you can use that $300 loss to reduce your taxable capital gains. This can be particularly useful at year-end, as it allows you to strategically manage your portfolio while keeping tax implications in mind. Just remember the wash sale rule: if you repurchase the same stock within 30 days, the IRS won't let you claim the loss. Now, let's shift gears and talk about dividends. If you're investing in stocks that pay dividends, it's essential to know how they are taxed. Qualified dividends are taxed at the lower capital gains rate, while non-qualified dividends are taxed at your ordinary income rate. To maximize your tax efficiency, focus on investing in companies that pay qualified dividends. This means doing a little research upfront, but it can pay off in the long run. For instance, if you receive $1,000 in qualified dividends, you'll pay less in taxes than if those dividends were non-qualified. Lastly, consider your overall investment strategy. Diversifying your investments and understanding your tax brackets can help you make more informed decisions. For example, if you know you're going to be in a lower tax bracket next year, it might make sense to realize some gains now while you're in a higher bracket. Also, if you're in a higher tax bracket, you might want to focus on tax-efficient funds, such as index funds or ETFs, as they typically generate fewer capital gains than actively managed funds. Alright, let's wrap things up. Today, we covered some essential strategies to help you reduce taxes on your investments, like using tax-advantaged accounts, understanding capital gains, tax loss harvesting, focusing on qualified dividends, and managing your overall investment strategy. By implementing these strategies, you can keep more of your investment returns in your pocket, allowing your wealth to grow even faster. Remember, a little knowledge goes a long way in financial planning. If you found this video helpful, please give us a thumbs up and consider subscribing for more personal finance tips. And don't forget to hit that notification bell so you never miss an update. Have any questions or other tax-saving strategies you'd like to share? Drop a comment below. Thanks for watching, and see you next time.